You wake up in the morning, and the reality of your financial situation hits you before your feet even hit the floor. Bills to pay, savings to build, and dreams to chase. But where do you even start? You don't have a clear plan, and the constant stress over managing money starts to feel like an unbreakable cycle. You've probably tried a few things here and there, but nothing really sticks. The thought of managing your finances seems overwhelming, like trying to juggle too many things at once, and something's bound to fall. But here's the thing. Money management is not as complicated as it may seem. It's about making simple, actionable changes that, over time, will transform the way you approach your finances. It's about understanding the basic principles and applying them consistently. Just like learning to ride a bike, it's all about balance, knowing how to handle your income, expenses, savings, and investments with control. When you master this balance, money stops being a source of stress and starts becoming a tool to create the life you want. So, where do you begin? How do you take control of your financial future when it feels like you're buried under a mountain of bills and uncertainty? The key to all of this is starting with a plan, and that plan starts with budgeting. Imagine you're about to build your dream house. The first thing you need is a solid foundation. Without it, no matter how fancy the walls and roof are, your house will eventually crumble. The same goes for your finances. Budgeting is your foundation. It's not just about cutting back on the fun stuff or depriving yourself. It's about creating a structure that ensures your money goes where it needs to, so you can pay your bills, save for the future, and still enjoy life along the way. But here's a reality check. Budgeting is often misunderstood. It's not a temporary fix or a quick and easy solution. It's a process that takes time, patience, and, most importantly, discipline. The good news is, once you get into the rhythm, it becomes second nature. The trick is getting started. Now, budgeting doesn't mean you need to live like a hermit, pinching pennies and feeling guilty for spending anything at all. No. A budget gives you freedom, the freedom to spend on what matters most, knowing that you're in control of your finances. Think of it as your personal financial roadmap. Without a budget, it's easy to veer off course and end up in a place where you don't want to be. But with one, you'll always know exactly where you're going and how to get there. Let's break it down into actionable steps to make this process easier. You don't have to be an expert to start managing your money effectively, but you do need to understand the basics. Step 1. Determine your motivation for budgeting. Before diving into the numbers, it's important to understand why you're creating a budget. What's the goal? Are you looking to save for a vacation, pay off debt, or simply gain better control of your spending? Your motivation will be the fuel that powers the process. When you don't have a strong reason for budgeting, it's easy to lose interest and fall back into old habits. But when you set a clear financial goal, everything changes. The act of budgeting becomes a means to an end. You're no longer just tracking expenses. You're working towards something that excites you. Whether it's financial freedom, a debt-free life, or building wealth, your goal will keep you focused and motivated. It doesn't matter if your goal is short-term or long-term. Whether it's paying off a credit card balance in 3 months or saving for a house down payment in 5 years. Having that specific motivation is key to staying committed. So, before you start, ask yourself, what do I want to achieve with my money? Step 2. Track your income and expenses. Now that you have your goal in mind, it's time to look at the practical side of budgeting. How much money is coming in, and how much is going out? Start by listing all of your sources of income. This could be your salary, freelance work, side gigs, or even passive income from investments. Don't forget about the little things, like cash gifts or side hustles. Write it all down so you can get an accurate picture of what you have to work with. Next, take a detailed look at your expenses. It's easy to overlook the small, everyday purchases that add up over time, like that daily coffee or impulse buys at the grocery store. But the goal here is to track everything. Write down all your fixed expenses, like rent or mortgage, utilities, insurance, and your variable expenses, groceries, dining out, shopping. The more detail, the better. You can use apps or a simple spreadsheet to help with this. In today's digital world, there's no shortage of tools to help you track your spending. You can link your bank account to apps like Mint or Pocket Guard to get a detailed breakdown of where your money is going. But don't just track your expenses for a week or a month and call it good. Consistent tracking is key to understanding your habits and recognizing patterns. Over time, you'll start to see where you can cut back and where you can afford to spend more. Step 3. Set your financial goals. Once you have a clear picture of your income and expenses, it's time to think about your financial goals. Having specific goals helps you stay on track and measure progress along the way. Without clear goals, it's easy to get lost in the day-to-day grind and forget why you're budgeting in the first place. You might be aiming to save for a big purchase, like a new car or a vacation. Or maybe you're working on building an emergency fund, paying off debt, or saving for retirement. Whatever your goals are, write them down. Being specific is important. Instead of vague goals like save more money, aim for something concrete like save $5,000 for an emergency fund by the end of the year. Break down big goals into smaller milestones. For example, if your goal is to save for a down payment on a house, you might set a goal of saving $300 every month for the next 12 months. When you break a big goal into smaller chunks, it's easier to see progress and stay motivated. Remember, it's not just about saving for the future. It's about enjoying the journey along the way. Having a mix of short-term and long-term goals keeps things interesting and helps maintain momentum. Step 4. Choose your budgeting method. Now that you know your goals and have a handle on your income and expenses, it's time to choose a budgeting method that works best for you. There's no one-size-fits-all approach here, so it's important to pick a system that suits your style. Some popular budgeting methods include zero-based budgeting. Every dollar of your income is assigned a job, whether it's for bills, savings, or fun. At the end of the month, your income minus your expenses should equal zero. This method is great if you want a high level of control over your finances and need to track every penny. 50-30-20 rule. This is a simpler approach where you divide your income into 3 categories: 50% for needs, housing, utilities, etc. 30% for wants, entertainment, dining out, and 20% for savings or debt repayment. This is a great method for beginners because it's straightforward and flexible. Envelope system. If you're a cash spender, this method could work for you. You allocate cash into envelopes based on categories, like groceries, entertainment, etc. Once the envelope is empty, you can't spend any more in that category. This method forces discipline and helps curb overspending. You don't have to choose just one method forever. You can experiment with different systems to see what works best for you. The important thing is to find a method that feels sustainable and keeps you motivated to stick to your budget. Step 5. Review and adjust regularly. Budgeting isn't a one-time task. It's an ongoing process. As life changes, so do your financial needs. Maybe you get a raise, or maybe your rent increases. The goal is to review and adjust your budget regularly to stay on track. At the end of each month, take a moment to review your progress. Did you meet your savings goal? Did you stick to your budget? If you overspent in certain categories, don't beat yourself up. Use it as a learning opportunity to adjust for the next month. Budgeting is all about trial and error, and as long as you're learning and adjusting, you're moving forward. The key to successful budgeting is to make it a habit. Don't wait until the end of the month to check your numbers. Regularly checking in on your spending, adjusting as necessary, and staying consistent will help you achieve your financial goals over time. Budgeting doesn't have to be daunting. It's about creating a strategy that aligns with your goals, understanding your money, and taking control. When you take the time to create a solid budget, you lay the foundation for financial freedom and peace of mind. By setting clear goals, tracking your spending, and adjusting as you go, you can build a sustainable money management system that works for you, not against you. The sooner you start, the sooner you'll see results. You've just set your budget, and things are starting to look clearer. But there's still a big question looming over you. How do you ensure your budget works for you in the long term? The answer lies in tracking your spending and saving consistently. If budgeting is the foundation of your financial house, then saving is the roof. It's what protects you from life's unexpected storms and allows you to build toward the future you envision. Let's dive into why saving is so crucial and how you can make it work for you. Step 1. Why saving matters. Imagine this. You're cruising through life, bills are paid, and you've got money in the bank. But then, out of nowhere, something unexpected happens. A medical emergency, car trouble, or the need to replace a broken appliance suddenly becomes a reality. If you don't have savings set aside for emergencies, what do? You either scramble to cover the cost, putting your finances at risk, or worse, you end up relying on credit cards or loans, which only adds more stress. That's why saving is crucial. It provides a safety net, a buffer that ensures you don't have to rely on debt to handle life's unexpected challenges. It's your cushion for those rough patches. But the benefits don't end there. Saving can also be your gateway to achieving bigger goals. Whether you're planning for a down payment on a house, building a retirement fund, or saving for an education, your savings will be the tool that helps you achieve these goals. Step 2. Start with small, manageable savings goals. A big mistake many people make is setting savings goals that are too large right out of the gate. $100,000 in savings sounds amazing. But if you're starting from scratch, it's easy to feel defeated before you even start. So, where should you begin? Start small. Setting a goal to save $50 or $100 a month might not seem like much at first, but over time, it adds up. Think of it as building momentum. The goal isn't to get rich overnight. It's to establish a savings habit that will grow over time. As you get more comfortable with saving, you can gradually increase the amount you set aside. Start by aiming to create an emergency fund. This should be your #1 priority when saving. Experts recommend having 3 to 6 months of living expenses in your emergency fund, which can cover unexpected situations like job loss, medical bills, or urgent home repairs. It might seem like a hefty goal at first, but once you break it down into monthly contributions, it becomes much more achievable. Step 3. Automate your savings. One of the biggest challenges in saving money is simply remembering to do it. It's easy to put it off when there's always something more urgent to pay. This is where automation comes in. Automating your savings makes saving money effortless. Once set up, your money will be automatically transferred into a savings account each month, before you even have the chance to spend it. Most banks and financial institutions offer easy ways to automate your savings, either through direct deposit or automatic transfers from your checking account to your savings account. This way, saving becomes a non-negotiable habit, and you don't have to think twice about it. Let's say you decide to set up an automatic transfer of $200 a month into a savings account. After a year, that's $2,400 saved. And the best part is, you didn't have to do anything beyond the initial setup. You're building wealth without even realizing it. Automation is especially helpful when you're living paycheck to paycheck. It might feel like you don't have the luxury of saving, but if you automate even a small portion of your income to be saved, you'll be surprised at how much you accumulate over time. Plus, the longer you wait to start saving, the harder it gets. So don't delay. The earlier you start automating, the sooner you'll see the benefits. Step 4. Track and monitor your savings progress. Just like your budget, tracking your savings progress is important. You wouldn't blindly drive a car without checking the road, so don't blindly save without checking your progress. This helps you stay motivated and reminds you of the bigger picture. Regularly reviewing your savings goals ensures that you're on track to meet your targets. If you've automated your savings, you don't need to worry about making sure the money is being transferred, but you should check in periodically to see how much you've accumulated and whether you need to adjust your savings targets. If you've already reached a smaller savings goal, like building a small emergency fund, you can start working on bigger goals. For example, you might start saving for retirement or a big purchase, like a home or a car. The key is to keep setting new milestones and pushing yourself toward them. Step 5. Reevaluate and adjust your savings plan. Life isn't static, and neither is your financial situation. As your income grows, expenses change, or your goals evolve. You should be adjusting your savings plan accordingly. If you get a raise at work or pay off a debt, you may find you have more disposable income available to save. Take advantage of these changes by adjusting your savings rate to reflect your new financial reality. Additionally, be mindful of inflation and rising living costs. The money you save today might not have the same purchasing power 5 or 10 years down the road. That's why it's essential to not only save, but also invest your money so it can outpace inflation. We'll get into investing later. But for now, just remember that saving alone may not always be enough to keep up with the cost of living in the long run. Even if your income stays relatively the same, look for ways to increase your savings rate. Could you cut back on discretionary spending, like dining out or entertainment? Can you find more affordable options for services or subscriptions you don't use as often? Small changes in your spending habits can result in big increases in your savings over time. Step 6. Be disciplined but flexible. Saving money isn't about being perfect, it's about being disciplined. The goal is to establish long-term saving habits that become second nature. But that doesn't mean you can't enjoy yourself along the way. Life is about balance. It's okay to splurge now and then, as long as it doesn't derail your long-term savings plan. Allow yourself flexibility. If you're saving for a big vacation or a home renovation, it's important to enjoy the journey. Don't deprive yourself entirely, or you might burn out and abandon your savings goals altogether. Instead, aim for a balance between saving and spending, making sure that you're setting aside enough to meet your goals, while also enjoying life in the present. Here's a tip. When you're feeling tempted to spend, ask yourself, will this purchase get me closer to my financial goals or further away? If it's something that supports your well-being and aligns with your goals, go for it. If not, remind yourself that you're building a better future, and that's worth the sacrifice. Building a savings habit doesn't happen overnight. It takes time, patience, and dedication. But when you start small, automate your savings, and keep tracking your progress, you'll be amazed at what you can achieve. Over time, your savings will grow, your goals will come into clearer view, and the financial stress that once seemed so overwhelming will slowly melt away. Remember, the sooner you start saving, the sooner you'll have the security and freedom you've been craving. Whether it's for an emergency, a big purchase, or just peace of mind, saving is the key to building the financial future you deserve. Now that you've taken control of your budget and started building your savings, the next step in your financial journey is to tackle one of the most stressful aspects of personal finance: debt. It's something many people deal with, yet few feel equipped to manage effectively. The weight of carrying debt, whether from student loans, credit cards, or personal loans, can be overwhelming. But here's the good news: you can get out of debt. It won't be easy, and it may take time. But with a solid plan and the right strategies, you can break free from the cycle of debt. This section will walk you through how to understand, prioritize, and pay off your debt so that you can achieve true financial freedom. Step 1. Understand your debt. Before you can start paying off debt, you need to have a clear understanding of what you owe. It's easy to ignore or bury your head in the sand when it comes to debt, but facing it head-on is the first step toward regaining control. Start by listing all your debts, including the total balance, the interest rate, and the minimum monthly payment for each. This includes everything: credit cards, car loans, mortgages, student loans, personal loans, medical bills, etc. If you have a mix of high-interest and low-interest debts, be sure to note those as well. Once you have the full picture, take a step back and assess the situation. How much total debt do you have? Are there any high-interest debts that are adding more financial strain than others? Understanding your debt is key to creating a plan that will allow you to chip away at it over time. One common mistake many people make is thinking that paying off a debt means simply making the minimum payments every month. In reality, unless you tackle the high-interest debt first, you could end up paying a lot more in interest over time, making it harder to escape the cycle. Take a hard look at your interest rates. High-interest debts, such as credit card balances, typically cost you the most. These debts should be your priority when it comes to repayment. Low-interest debts, like student loans or mortgages, can be tackled later, as they won't accumulate interest as quickly. Step 2. Prioritize your debts. Once you've gained a clear understanding of your debt, the next step is to prioritize which debts to pay off first. There are several strategies you can use, and the best one for you will depend on your specific situation and goals. The debt avalanche method. One of the most efficient ways to tackle debt is the debt avalanche method. With this method, you focus on paying off the debt with the highest interest rate first. This could be a credit card balance or a personal loan, and it's often the most expensive debt in the long run. The logic behind the avalanche method is simple. By paying off the highest interest debt first, you save more money in interest charges. Once the highest interest debt is paid off, you move on to the next highest, and so on. This approach allows you to eliminate your debt faster and with less interest paid over time. The debt snowball method. Alternatively, you can use the debt snowball method, which focuses on paying off the smallest debt first, regardless of interest rate. This method provides a psychological boost because you get to check off smaller debts and build momentum as you go. For many people, the sense of accomplishment and progress is motivating enough to keep pushing forward. While the debt snowball method may not save you as much money in interest compared to the avalanche method, it can be incredibly effective if you need that extra push of motivation. It's all about finding what works best for you. Step 3. Make extra payments whenever possible. Once you've chosen your debt repayment strategy, it's time to put your plan into action. While making the minimum payments is important to avoid penalties and keep your accounts in good standing, making extra payments is what accelerates your progress. Any extra money you can put toward your debt, whether it's from a bonus, a tax refund, or cutting back on non-essential spending, can go a long way. Even small, additional payments can shave months or even years off your debt repayment timeline. Consider allocating any windfalls, whether it's a tax refund, a work bonus, or a side hustle income, directly toward your debt. Every little bit helps, and the faster you pay off your debt, the less you'll pay in interest, ultimately saving you money. Step 4. Avoid creating new debt. As you work toward eliminating your existing debt, it's equally important to avoid creating new debt. It's easy to fall into the trap of charging up your credit cards or taking out new loans when you start to see some progress. But maintaining that progress requires discipline. One of the best ways to avoid taking on new debt is to continue following your budget. By sticking to a plan and having a clear understanding of what you can afford to spend, you'll be less likely to make impulsive purchases or rack up credit card bills. If you have credit cards, it's a good idea to use them sparingly and only for planned purchases. Try to pay off your balance in full each month to avoid accumulating more debt. If you're struggling with credit card balances, it might be worth considering transferring your debt to a card with a lower interest rate or consolidating your debt to make it easier to manage. Step 5. Refinance or consolidate debt. If you find yourself juggling multiple debts with high interest rates, it might be worth considering refinancing or consolidating your debt. These options can help lower your interest rates and simplify your monthly payments. Debt consolidation involves combining multiple debts into a single loan with a lower interest rate, allowing you to make one payment instead of several. This can help reduce the amount of interest you pay and make it easier to manage your debt. Refinancing involves taking out a new loan to pay off existing debt, often at a lower interest rate. This can help you save on interest charges, especially if your credit score has improved since you took out the original loans. Before deciding to refinance or consolidate, make sure you understand the terms of the new loan. Look for any fees or penalties that may apply and compare the interest rates with your current debts to ensure that it's a good financial decision. Step 6. Set up an emergency fund. While you're focused on paying off debt, it's important to keep one eye on the future and start building an emergency fund. Life is unpredictable, and unexpected expenses can derail even the best planned budgets. Having a buffer can keep you from reaching for your credit card or taking out a loan when an emergency arises. Aim to build an emergency fund that covers 3 to 6 months of living expenses. This fund should be used for unexpected situations like medical bills, car repairs, or job loss. Once you've established your emergency fund, you can turn your full attention to paying off your remaining debt. Step 7. Celebrate your progress and stay consistent. As you make progress on your debt repayment journey, remember to celebrate your victories, no matter how small they may seem. Paying off a credit card or student loan is no easy feat, and every milestone is worth acknowledging. Once you're debt-free, you'll have a sense of freedom and peace of mind that's invaluable. But the work doesn't stop there. The key to staying debt-free is consistency. Continue following your budget, building your savings, and making smart financial decisions. Staying debt-free is all about maintaining healthy financial habits, like saving regularly, avoiding unnecessary purchases, and keeping track of your spending. Debt doesn't have to be a lifelong burden. By understanding your debt, prioritizing repayment, and staying disciplined, you can free yourself from financial stress and achieve your financial goals. The road to becoming debt-free is a marathon, not a sprint. But every step you take brings you closer to your ultimate financial freedom. Keep pushing forward, and soon, that debt won't feel so heavy anymore. By now, you've gained control over budgeting, built a savings habit, and started tackling your debt. These are powerful steps toward achieving financial security. But what about the future? What happens when you've paid off your debt, saved up an emergency fund, and covered your immediate financial needs? This is where investing comes in. Investing might sound intimidating, especially if you're just starting out with managing your money. It's often portrayed as a realm only for the wealthy or highly experienced. But the truth is, investing is something everyone can do, and it's one of the most effective ways to build long-term wealth. Understanding how to invest wisely will help you achieve financial goals that extend beyond the short term. Goals like retirement, buying a home, or creating generational wealth. So, how do you step into the world of investing with confidence? Let's break it down. Step 1. Understand the basics of investing. Before you start investing, it's important to get familiar with the basic concepts. Investing means putting your money into assets with the expectation that it will grow over time. The goal is to create wealth by taking calculated risks, while still maintaining control over your financial future. The two most common types of investments are stocks. When you buy stock, you're buying a small piece of a company. If the company does well, the value of the stock typically goes up, and you can sell it for a profit. However, stocks can also go down in value if the company underperforms. Bonds. Bonds are essentially loans you give to governments or companies in exchange for interest payments. Bonds are typically less risky than stocks, but they also offer lower returns. They can be a good option if you want to preserve capital while still earning some interest. There are other investment options out there as well, like real estate, mutual funds, and exchange-traded funds, ETFs. But understanding stocks and bonds is a great starting point. The key is to diversify, which means spreading your investments across different types of assets to minimize risk. Step 2. Start with retirement accounts. One of the best ways to start investing is by contributing to retirement accounts, such as a 401k or an individual retirement account, IRA. These accounts offer significant tax advantages and are specifically designed to help you save for retirement. The 401k plan. Many employers offer a 401k plan where you can automatically contribute a portion of your paycheck before taxes are taken out. If your employer offers a match, meaning they contribute a certain amount to your 401k based on your contributions, Take full advantage of it. This is essentially free money and can significantly boost your retirement savings. The IRA. If your employer doesn't offer a 401k, or if you want to supplement your retirement savings, consider opening an IRA. There are two types, traditional and Roth. A traditional IRA allows you to deduct contributions from your taxes, while a Roth IRA offers tax-free withdrawals in retirement. Both types are excellent ways to grow your savings in a tax-advantaged way. Retirement accounts are ideal for long-term investing, and because they offer tax benefits, the earlier you start contributing, the more you'll benefit from compound growth over time. Step 3. Consider low-cost index funds and ETFs. If you're not ready to pick individual stocks or bonds, index funds and ETFs are great options for beginners. These funds pool money from multiple investors to buy a broad variety of stocks or bonds. The beauty of index funds is that they track the overall market, meaning you get exposure to a wide range of companies or sectors, which helps reduce risk. For example, an S&P 500 index fund gives you exposure to the 500 largest companies in the United States. By investing in this fund, you're betting on the success of the overall market, rather than individual companies. Over time, the S&P 500 has delivered an average annual return of around 7 to 10%, which is a solid return for a relatively low-risk investment. ETFs, exchange-traded funds, are similar to index funds, but they trade like stocks on the exchange. This means you can buy and sell shares of ETFs throughout the day, just like individual stocks. Both index funds and ETFs are considered to be low-cost, diversified investments, making them ideal for beginners. Step 4. Understand your risk tolerance. Before diving into any investment, it's crucial to assess your risk tolerance. In other words, how much risk you're willing to take on. All investments come with some level of risk, but higher risk investments, like stocks, generally offer the potential for higher returns. On the other hand, lower risk investments, like bonds, offer more stability, but often come with lower returns. Your risk tolerance depends on a few factors. Your financial goals. Are you saving for a short-term goal, like a vacation or a new car? Or are you focused on long-term wealth building, like retirement? Your time horizon. The more time you have before you need to access your funds, the more risk you can afford to take on. For example, if you're 25 and saving for retirement, you can afford to invest in riskier assets because you have decades to ride out market fluctuations. Your personality. Some people are comfortable with the ups and downs of the stock market, while others prefer the peace of mind that comes with safer investments. It's important to strike a balance between risk and reward that suits your financial situation and goals. A good rule of thumb is to adjust your risk level as you get closer to your financial goal. The closer you are to needing the money, the more conservative you should be with your investments. Step 5. Stay consistent and avoid timing the market. One of the biggest mistakes new investors make is trying to time the market. That is, attempting to buy and sell investments at the perfect time to maximize profits. The reality is that no one can predict market fluctuations with certainty, and trying to time the market often leads to poor decision-making. Instead, focus on staying consistent. Set up regular contributions to your investment accounts, whether it's through your 401k, an IRA, or a taxable brokerage account, and stick with it. Over time, the market has historically gone up, and consistent investing, particularly in diversified assets, generally leads to positive returns in the long run. If you're investing in individual stocks or funds, avoid checking your portfolio every day. Instead, commit to reviewing it periodically, say, once a quarter or once a year. This will keep you from making emotional decisions based on short-term market movements. Step 6. Rebalance your portfolio regularly. As you continue to invest, your asset allocation, the percentage of your portfolio in stocks, bonds, and other assets, will shift over time due to market performance. For example, if stocks perform well, they may represent a larger portion of your portfolio than you initially intended. To keep your portfolio aligned with your risk tolerance and goals, it's important to rebalance your portfolio regularly. Rebalancing involves selling some of your best-performing assets and buying more of your underperforming assets to maintain the desired allocation. You don't need to rebalance constantly, but it's a good idea to review your portfolio at least once a year and make adjustments if necessary. Step 7. Be patient and think long-term. The final step in your investing journey is to be patient. Investing is a long-term strategy that rewards consistency, not quick wins. The earlier you start investing, the more time your money has to grow. Compound interest, which is the process of earning interest on both your initial investment and the interest it has already accumulated, is your best friend in the world of investing. While the market will experience short-term fluctuations, the overall trend over the long term has historically been upward. Staying invested through thick and thin, especially during market downturns, is often the best way to build wealth. If you stick to your plan and avoid emotional decisions, your investments will likely grow steadily over time. Investing may seem daunting at first, but with the right approach, it's a powerful way to build wealth and secure your future. By understanding the basics, starting with retirement accounts, diversifying your investments, and staying consistent, you're well on your way to becoming a successful investor. Remember, investing isn't about getting rich quickly. It's about building lasting wealth through smart, consistent decisions. Start today, stay patient, and watch your money grow. You've mastered budgeting, saving, and tackling debt. You've even started investing and have begun to see the fruits of your efforts. But there's one more critical piece to your financial puzzle: avoiding common money management mistakes. It's easy to get caught up in the hustle of day-to-day life, but small missteps can have long-term consequences for your financial health. In this section, we'll uncover some of the most common money management mistakes and how you can avoid them. Recognizing these mistakes and learning how to navigate around them will not only help you safeguard your progress, but also accelerate your journey toward financial freedom. Mistake 1. Failing to set clear financial goals. It's easy to get lost in the weeds of budgeting, saving, and investing without a clear destination in mind. Without specific, measurable financial goals, it's impossible to know if you're making real progress. For example, saying, "I want to save more," is vague and doesn't provide you with a roadmap. Instead, set a specific goal, like, "I want to save $10,000 for a down payment on a house in 2 years." This goal is measurable, time-bound, and actionable, which gives you the clarity to create a plan to reach it. When you break down larger goals into smaller, more manageable steps, the path becomes much clearer. Set short-term, mid-term, and long-term goals that reflect your financial priorities. Remember, goals give you the motivation to stay on track and help you make informed decisions about your money. If you're not sure where to start, here are some examples of common financial goals to help you brainstorm. Paying off a credit card balance within 6 months. Building an emergency fund of 3 to 6 months' worth of expenses. saving for a child's education or your retirement, investing for a future home purchase. Mistake 2. Not tracking your expenses. One of the biggest barriers to effective money management is not knowing where your money goes. Without understanding your spending habits, it's nearly impossible to stick to your budget or see where you can improve. The solution is simple. Track every penny. At first, this may feel like a tedious task, but it's the best way to identify areas where you might be overspending. You don't have to do this manually. Apps like Mint, YNAB, You Need a Budget, or Pocket Guard make it easy to track your expenses and categorize your spending. Tracking expenses doesn't just mean recording purchases. It means reviewing your spending regularly. If you notice that you're spending more on dining out than you'd like, or subscribing to services you don't use, you can make informed decisions about where to cut back. Don't let the little expenses slip through the cracks. It's those small, seemingly insignificant purchases that add up over time and derail your budget. By tracking them, you gain awareness and control over your money, making it easier to stick to your goals. Mistake 3. Living beyond your means. We've all seen the flashy advertisements and social media influencers showing off the latest gadgets, designer clothes, or dream vacations. It can be easy to get caught up in the idea that you need those things to feel happy or successful. But the reality is, living beyond your means is one of the quickest ways to spiral into debt and sabotage your financial stability. The key here is living within your budget, and in some cases, even below it. This might mean choosing a more affordable apartment, cutting back on expensive hobbies, or opting for a smaller, more economical car. The goal isn't to deprive yourself. It's to prioritize your financial health and future by making responsible spending choices. Delayed gratification is a powerful tool in building long-term wealth. The more you can resist the urge to keep up with the latest trends or buy things you don't really need, the more money you'll have available to save, invest, and secure your financial future. Take a step back and ask yourself, do I need this purchase, or do I just want it? Will buying this item bring me closer to my financial goals, or will it push me further away? The more you focus on your priorities, the less likely you'll be to fall victim to lifestyle inflation. Mistake 4. Ignoring your credit score. Your credit score is more than just a number. It's a reflection of how financially responsible you are, and a major factor in determining your ability to borrow money. Whether you're applying for a mortgage, auto loan, or credit card, your credit score can significantly impact the interest rates and terms you're offered. A poor credit score can cost you thousands in higher interest rates over the course of a loan, while a good credit score can save you a substantial amount of money. So, it's crucial to check your credit regularly and make sure it's in good shape. If you notice that your credit score is lower than you'd like, take the time to review your credit report and look for any errors or negative items that may be dragging it down. If you have missed payments or high credit card balances, focus on paying down debt and making on-time payments to improve your score. Here are some steps to boost your credit score. Pay your bills on time. Keep your credit card balances low, ideally under 30% of your available credit. Avoid opening too many new credit accounts at once. Regularly check your credit report for errors. Improving your credit score takes time, but small, consistent actions can make a big difference. And the better your credit score, the more favorable loan terms you'll receive, which will save you money in the long run. Mistake 5. Trying to keep up with others. Comparing your financial situation to others is a surefire way to set yourself up for dissatisfaction and financial stress. Everyone's financial journey is unique, and just because someone else seems to have it all together doesn't mean they're financially healthy. Keeping up with the Joneses will only lead to unhealthy financial decisions and unnecessary stress. Focus on your own financial goals and make decisions based on your personal values, not someone else's lifestyle. It's easy to fall into the trap of spending to impress others, but ultimately, it's your financial future that matters. By sticking to your budget, saving diligently, and investing for your future, you're creating a solid foundation for your own financial success, regardless of what others are doing. Celebrate your progress, no matter how small, and keep your eyes on your long-term goals. Mistake 6. Not having an emergency fund. An emergency fund is one of the most important financial tools you can have. This fund is your safety net, protecting you from the financial impact of unexpected events like job loss, medical emergencies, or urgent car repairs. Without an emergency fund, you risk relying on credit cards or loans to cover these costs, which can put you deeper into debt. Ideally, your emergency fund should cover 3 to 6 months of living expenses. But even if you can't build that much right away, start with whatever you can. The important thing is to get started and make it a priority. You can build your emergency fund over time by setting aside small, consistent amounts from each paycheck. Automating your savings, as mentioned earlier, can help ensure that you're consistently building this fund. Mistake 7. Delaying retirement savings. It's easy to put off saving for retirement when you're in the thick of managing daily expenses and financial goals. But the earlier you start saving for retirement, the better. Thanks to compound interest, even small contributions can grow significantly over time. The key is to start as soon as possible, whether it's through your employer's 401k, a Roth IRA, or another retirement account. Start contributing now. Don't wait for the perfect time, because the perfect time is now. The longer you wait, the less time your money has to grow, which can make a big difference when you're ready to retire. If you're unsure how much to save, aim for at least 10–15% of your income, even if it's a small amount at first. Start building that habit. As your income increases over time, increase your contributions to keep up. Avoiding common mistakes is just as important as taking the right steps in money management. By staying vigilant, setting clear goals, tracking your expenses, and staying disciplined, you can avoid the pitfalls that derail many people's financial journeys. Financial success isn't about perfection. It's about consistency. Make the right choices, stay on track, and don't be afraid to adjust your course when necessary. Remember, building wealth is a marathon, not a sprint. Every step you take now brings you closer to financial freedom and the peace of mind that comes with it. By now, you've set a solid foundation, budgeting, saving, investing, and avoiding common financial pitfalls. You're steadily making progress toward financial freedom. But here's the question: how do you ensure that this progress continues and that you don't fall back into old habits? The answer lies in creating a sustainable financial plan that goes beyond the day-to-day tasks and integrates your financial goals into your broader life vision. This is where the concept of financial habits comes into play. What you do with your money today shapes the future you'll have tomorrow. Building a sustainable financial plan is about creating a system that works not just for now, but for years to come. It's about fostering habits that automatically align your money decisions with your long-term goals. habits that become second nature and empower you to keep moving forward, no matter what life throws your way. So, how can you create a financial plan that works for you, ensures you stay on track, and lets you continue building wealth for the future? Step 1. Review your financial goals regularly. Creating your financial plan begins with setting clear, actionable goals. But it doesn't stop there. Your goals need to evolve over time as your financial situation changes. Life is dynamic, and your financial goals should reflect that. Let's say you started by saving for an emergency fund, and now that you've reached your goal, it's time to shift gears and focus on saving for a home down payment or increasing your retirement contributions. Or perhaps you've paid off all your consumer debt, and now your focus is on growing your investment portfolio or expanding your side business. Review your goals at least once every 6 months to make sure they still align with your current life stage and ambitions. What once seemed like an urgent goal may no longer be as important as it once was. On the flip side, new priorities may have emerged that you need to address. Use your financial review as an opportunity to reflect on your progress, celebrate your wins, and adjust your approach if necessary. It's an ongoing process, an evolving journey that keeps you grounded and ensures you're always working toward what truly matters. Step 2. Develop and strengthen your financial habits. Creating a sustainable financial plan isn't just about having the right goals. It's about embedding the right habits into your life. Habits are the key to lasting success. They transform short-term actions into long-term results. Let's take a look at a few financial habits you can build into your daily life. Habit number 1. Automate your finances. Automation is your best friend when it comes to long-term financial success. The beauty of automation is that it takes the effort out of saving and investing. If you've already automated your savings, consider automating your bill payments as well. Automating your finances ensures that you never miss a payment, avoid late fees, and stay consistent in reaching your goals. It also reduces stress and eliminates the temptation to spend money that should be saved or invested elsewhere. Habit number 2. Set monthly reviews. At the beginning of each month, take a moment to review your budget, spending, and savings goals. This quick check-in will help you stay on top of your financial habits and see if any adjustments need to be made. It's a good time to assess whether you've met your savings target for the month, and it keeps you engaged with your finances. By regularly reviewing your progress, you'll catch any deviations before they snowball into larger problems. Habit number 3. Live below your means. Building a habit of living below your means is one of the most powerful financial habits you can cultivate. It's not about depriving yourself. It's about understanding the difference between your needs and wants and making conscious decisions to prioritize your financial future. Living below your means allows you to put more money towards savings and investments, helping you achieve your financial goals faster. Living below your means also means resisting lifestyle inflation, which happens when your spending increases as your income increases. Instead of automatically upgrading your lifestyle when you get a raise, focus on saving and investing the extra money. This allows you to build wealth more rapidly and creates a greater sense of financial security. Habit number 4. Continue learning about personal finance. Financial literacy is something that should be nurtured continuously. The more you learn, the better equipped you'll be to make informed decisions with your money. Reading books, listening to podcasts, attending webinars, or following personal finance blogs can deepen your knowledge and give you new insights into managing money effectively. Consider taking time each month to read articles or listen to financial podcasts that align with your current goals, whether it's understanding tax strategies, learning about real estate investing, or understanding how to maximize your retirement contributions. Consistent learning empowers you to make smarter decisions that benefit your future. Step 3. Build financial resilience. Building financial resilience means preparing yourself for the unexpected and ensuring you can bounce back from setbacks. Life is unpredictable. Emergencies happen, and economic downturns are inevitable. Financial resilience is about equipping yourself with the tools and strategies to weather those storms without losing ground. The foundation of financial resilience is having a robust emergency fund. This fund allows you to handle unexpected costs, like medical bills or car repairs, without falling back on credit cards or loans. As you continue building your emergency fund, consider setting aside at least 6 months of living expenses to cover any potential disruptions in your income. This is especially important if you're self-employed or have a variable income. Another aspect of financial resilience is having diversified investments. Relying too heavily on one type of asset, whether that's a single stock, company, or industry, can expose you to significant risk. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., you reduce your risk and increase your ability to weather market downturns. Also, keep in mind the value of adequate insurance coverage. Health insurance, car insurance, home insurance, and life insurance are critical components of financial resilience, as they protect you from major financial setbacks that can arise from unforeseen circumstances. Step 4. Reinvest in your future. As you gain financial momentum, you might start to notice the benefits of your efforts: more savings, growing investments, and a reduced reliance on debt. This is where you have the opportunity to reinvest in your future. Reinvesting isn't just about throwing more money into the market or expanding your savings. It's about strategically growing your wealth and ensuring that every financial decision you make brings you closer to your long-term vision. One of the ways to reinvest is to continue building on your investment portfolio. As your income increases, consider upping your monthly contributions to retirement accounts or expanding into other areas like real estate or alternative investments. Diversifying your portfolio and increasing your investments will increase the potential for compound growth, helping you achieve financial independence faster. Another way to reinvest in yourself is through education and skill development. Whether you're learning new skills to enhance your career, building a business, or investing in furthering your education, personal growth is an important part of long-term financial success. By investing in yourself, you open up opportunities for higher income, greater job satisfaction, and personal fulfillment. Step 5. Surround yourself with a support system. Building wealth is a personal journey, but that doesn't mean you have to do it alone. Surrounding yourself with a support system, whether that's a financial advisor, a mentor, or friends and family who share your values, can significantly improve your chances of success. Having a support system can keep you accountable, provide encouragement during difficult times, and offer fresh perspectives when you encounter challenges. Whether it's a friend you can share budgeting tips with, a family member who offers sound financial advice, or a professional advisor who guides your investment strategy, the support you receive can make a world of difference in staying motivated and on track. Step 6. Stay disciplined and focused. The journey toward financial freedom is long, but the rewards are more than worth it. However, the key to sustained success is discipline. Staying focused on your goals, continuing to follow your budget, saving consistently, and making informed investment choices will all contribute to building lasting wealth. There will be times when it feels challenging. The temptation to splurge, the lure of taking on unnecessary debt, or the impatience to see faster results will test your resolve. But remember, it's about the long-term picture, not short-term gratification. Discipline today means security tomorrow. Your financial journey is a marathon, not a sprint. By creating a sustainable financial plan, building lasting habits, and staying focused on your long-term goals, you will steadily make progress toward financial freedom. Success isn't about quick fixes or overnight wealth. It's about consistency and smart decisions that pay off over time. And remember, the path you're on is just as important as the destination. Celebrate the small wins along the way. Stay committed to your plan and keep moving forward. Your future self will thank you. At this stage, you've made significant strides toward building a solid financial foundation. You've got your budgeting, saving, and investing under control, and you're working hard to avoid common mistakes. But as your wealth grows, so does the complexity of your financial situation. This is when you need to start thinking about long-term wealth management. Wealth management is about more than just making smart financial decisions today. It's about setting yourself up for continued success over the decades to come. It's about growing your money, protecting it, and passing it down to future generations if that's part of your vision. And while you might have started your journey focusing on the basics, long-term wealth management brings a new layer of strategy, protection, and foresight into the equation. So, how do you shift from managing your finances day to day to managing wealth for the long term? Let's explore the steps you can take now to ensure your future financial security. Step 1. Diversify your investments. As you build wealth, it's essential to think about diversification, not just in terms of your assets, but also in the types of investments you hold. Diversification is one of the most effective ways to manage risk. By spreading your investments across different asset classes, industries, and geographical areas, you reduce the likelihood that a downturn in one area of the market will decimate your entire portfolio. The simplest example of diversification is spreading your investments between stocks, bonds, real estate, and cash equivalents like money market funds. This balance can help you take advantage of growth opportunities while protecting your wealth from market volatility. Additionally, consider global diversification. Investing in international markets gives you exposure to opportunities outside your home country, which can reduce risk and increase your potential for returns. Global diversification can be achieved through international funds or direct investment in foreign stocks. Real estate is another common form of diversification that has long-term wealth-building potential, whether through residential or commercial properties, or even real estate investment trusts, REITs. Real estate provides an opportunity for both capital appreciation and steady income. The key is to regularly rebalance your portfolio to make sure your diversification strategy still aligns with your financial goals and risk tolerance. Rebalancing ensures that you maintain the right mix of assets over time, without being overly exposed to any one risk. Step 2. Build a tax-efficient strategy. One of the most effective ways to build wealth is to minimize the impact of taxes on your earnings. This doesn't mean avoiding taxes, that's illegal, but it does mean strategically managing your investments and income to keep as much of your money as possible. A tax-efficient strategy involves several components: tax-advantaged accounts, Maximize contributions to tax-advantaged accounts like your 401k, IRA, or Health Savings Account, HSA. These accounts provide tax breaks that reduce your taxable income, allowing your investments to grow without being taxed until you withdraw funds. The more you contribute to these accounts, the more your wealth can compound without the drag of taxes. Capital gains. Strategy. Understand the difference between short-term capital gains from assets held for less than a year and long-term capital gains from assets held for more than a year. Short-term capital gains are taxed at a higher rate, so holding investments for the long term can reduce your tax burden and allow your investments to grow at a faster rate. Tax-efficient investments. Some investments are more tax-efficient than others. Index funds and ETFs, for example, tend to be more tax-efficient than actively managed funds because they have lower turnover, meaning there are fewer taxable events. This is a simple way to save on taxes while still building wealth. Step 3. Focus on asset protection. As your wealth grows, it's important to think about asset protection. You don't want all the hard work you've done to be undone by an unexpected lawsuit, a medical emergency, or another unforeseen event. Asset protection involves structuring your finances in a way that shields your wealth from creditors, legal action, or other risks. Here are a few strategies for protecting your assets. Insurance. Having the right types of insurance in place is a crucial step in protecting your wealth. Consider comprehensive health insurance, disability insurance, homeowners insurance, and life insurance to protect your family and assets. Additionally, umbrella insurance offers extra liability protection beyond the limits of your home or auto insurance policies. Estate planning. One of the most important ways to protect your assets long-term is through estate planning. Having a will or trust in place ensures that your wealth will be distributed according to your wishes when you pass away. It also helps minimize estate taxes and prevent lengthy legal battles that can deplete your wealth. Legal structures. For higher net worth individuals, creating a legal structure such as a limited liability company, LLC, or a family limited partnership, FLP, can offer further protection from creditors. These structures can separate personal assets from business assets, which may provide additional safeguards against lawsuits or other financial risks. Step 4. Focus on passive income streams. As you continue building wealth, it's important to think about how you can create passive income streams, sources of income that don't require you to actively work for them. Passive income can come from various sources. Real estate. Owning rental properties is a classic way to generate passive income. Whether you own residential or commercial properties, rental income can provide a steady cash flow that's relatively predictable over time. Additionally, real estate tends to appreciate in value over the long term, adding to your overall wealth. Dividends and interest. Investing in dividend-paying stocks, bonds, or mutual funds can provide a reliable source of passive income. These types of investments pay you a portion of their earnings on a regular basis, quarterly, monthly, or annually, without you having to sell your assets. Royalties and intellectual property. If you've created something of value, like a book, patent, or software, you can earn royalties or licensing fees. These are payments made to you for allowing others to use your intellectual property, and they provide a passive income stream. The more passive income streams you have, the less reliant you become on your active income, salary, business income, etc. This creates greater financial freedom and reduces your dependency on working for money. The goal is for your money to start working for you. Step 5. Plan for legacy and generational wealth. Once you've reached a point where you've accumulated significant wealth, generational wealth planning becomes a priority. You may want to pass on your wealth to your children, grandchildren, or other loved ones, while ensuring it's protected, preserved, and grows over time. Here's how you can build and pass on generational wealth. Trusts and estates. Setting up a trust allows you to designate how and when your wealth will be distributed to your heirs. Trusts can help avoid probate, minimize estate taxes, and provide for family members in the way you see fit. It's important to work with a financial advisor or estate planner to ensure your wealth is structured in the most tax-efficient way possible. Financial education. One of the most valuable things you can pass down to your family is financial education. Teaching your children about managing money, saving, investing, and building wealth will help them maintain the wealth you've worked so hard to accumulate. Financial literacy is the key to ensuring that generational wealth is not squandered, but rather passed down for future generations to enjoy and grow. Step 6. Stay the course and be patient. Wealth management is not a get-rich-quick scheme. It's about making smart, long-term decisions that pay off over time. Patience is one of the most powerful tools in building wealth. The more you stick to your plan, adjust it when necessary, and allow your investments to grow, the more you'll see the compounding effect take hold. Stay disciplined, keep learning, and always remember your long-term vision. The journey may not always be smooth, but the rewards are more than worth it. As you continue to grow your wealth, remember that financial freedom is not a destination, it's a process. By diversifying your investments, building tax-efficient strategies, protecting your assets, and planning for the future, you're creating a strong foundation that will carry you through whatever life throws your way. Keep moving forward, stay focused, and let your financial plan work for you, today, tomorrow, and for years to come. At this point, you've made remarkable progress on your financial journey. You've mastered the basics, built solid habits, and even started to think long-term. But now, it's time to consider something truly transformative: financial independence. Achieving financial independence isn't about simply accumulating wealth. It's about giving yourself the freedom to live life on your terms, without being chained to a paycheck or debt. It's about creating a life where money works for you, rather than the other way around. The path to financial independence may take years, but with the right strategies in place, it's entirely possible. In this section, we're going to explore how you can move beyond just managing your money to actively building the wealth and lifestyle that aligns with your deepest values. Step 1. Define what financial independence means to you. Before you can achieve financial independence, you need to understand exactly what it means for you. For some people, it might mean being able to retire early, while for others, it could mean the ability to travel freely, pursue passion projects, or simply have more time to spend with family. Financial independence looks different for everyone, and it's essential to define what it means in the context of your life. Think about the lifestyle you want. Do you envision a future of relaxed vacations, owning a home without a mortgage, or perhaps starting your own business? Once you have a clear vision of your ideal future, you can set goals that align with your desires. This gives your financial planning purpose, making each step you take feel more meaningful. The best way to define your version of financial independence is to ask yourself, what do I want my life to look like in 10, 20, or even 30 years. The more specific your vision, the easier it will be to create actionable goals to get there. Financial independence is about freedom, but it's also about living intentionally and aligning your money with what truly matters to you. Step 2. Calculate your financial independence number. Once you've defined what financial independence looks like for you, it's time to calculate how much money you'll need to achieve that goal. This is often called your financial independence number. It's the amount of money you need to have invested, generating passive income, so that you no longer have to rely on a paycheck to support your lifestyle. To calculate your financial independence number, start by determining your annual expenses. This is how much money you need to live comfortably each year. Don't forget to include things like housing, utilities, food and groceries, healthcare, travel or entertainment, savings for emergencies. Once you know your annual expenses, the general rule of thumb is to multiply that number by 25. This calculation comes from the 4% rule, which suggests that if you withdraw 4% of your investments per year, your money will last indefinitely. For example, if your annual expenses are $40,000, you would need $1,000 invested to be financially independent. This number is your target. It may seem daunting at first, but remember, the more you save and invest, the closer you get to your goal. If you have a large amount of debt, part of your journey will include eliminating that debt to lower your annual expenses, which will make your target number more achievable. Step 3. Maximize your savings rate. To achieve financial independence, the faster you can grow your investments, the better. And the key to growing your wealth faster is to maximize your savings rate, the percentage of your income that you save and invest. In the beginning, you may feel like you're barely able to save enough for emergencies, let alone financial independence. But the more you adjust your lifestyle to save aggressively, the more quickly you can reach your target number. Start by increasing the amount you contribute to your retirement accounts, such as a 401k or IRA, but also look for other ways to boost your savings rate. Cutting back on discretionary spending. This doesn't mean depriving yourself, but finding ways to reduce unnecessary expenses. Cutting back on luxury items, eating out less, or finding cheaper alternatives for entertainment can free up a surprising amount of money each month. Increasing your income. Consider side gigs, freelancing, or passive income streams to boost your earnings. The more money you bring in, the faster you can invest and grow your wealth. Automating your savings. Set up automatic transfers from your checking account to savings or investment accounts. The less you think about saving, the more likely you are to succeed. By maximizing your savings rate, you create a powerful momentum effect. The higher the percentage of your income that goes toward your future, the quicker you'll reach financial independence. Step 4. Invest wisely and continue to diversify. The key to building wealth quickly is not just saving, but investing your savings in a way that allows it to grow. Simply keeping your money in a savings account isn't enough. It won't outpace inflation, and it certainly won't help you reach financial independence. That's where compounding comes into play. The earlier you start investing, the more time your money has to grow. Over time, your returns generate their own returns, and your wealth snowballs. The earlier you start, the less you need to save each month to reach your goal. Continue to focus on diversification when investing. A mix of stocks, bonds, real estate, and other assets ensures you aren't overly reliant on one sector or asset class. As you build wealth, Consider adjusting your investments to match your risk tolerance and time horizon. If you're still in the early stages of your journey, you might be comfortable taking on more risk for potentially higher returns. But as you get closer to financial independence, you might want to shift toward more conservative investments to preserve your capital. ETFs, mutual funds, and index funds are excellent options for diversifying your investments with lower fees and less effort. These funds automatically pool your money with other investors and diversify it across different companies, industries, and regions, spreading the risk while still providing growth potential. Step 5. Plan for your financial independence lifestyle. Achieving financial independence doesn't just mean accumulating wealth. It means knowing what to do with that wealth when you get there. It's important to have a clear plan for your financial independence lifestyle. When you no longer rely on a paycheck, how will you spend your time? Will you travel the world, pursue a passion project, spend more time with your family? Whatever your vision is, make sure your financial independence plan is aligned with how you want to live. This is also a good time to think about the social and emotional aspects of financial independence. Often, the pursuit of financial independence isn't just about the money. It's about the freedom to choose how you live your life. Consider how you'll manage your time, relationships, and personal goals when your financial security is no longer tied to a job or conventional career path. Step 6. Stay disciplined and committed. Achieving financial independence requires a long-term mindset. It's a marathon, not a sprint. While you'll experience small wins along the way, the ultimate goal is to stay disciplined, keep your focus on the big picture, and avoid distractions. Don't be tempted by the latest trends or lifestyle inflation. Staying the course is critical. Remind yourself regularly why you're doing this, whether it's enjoying time with loved ones, pursuing a passion, or simply having the freedom to choose your own path. Keeping your why in mind will help you stay motivated through the ups and downs. The road to financial independence isn't easy, but it is possible. By consistently saving, investing, and making smart financial decisions, you can achieve the freedom to live life on your own terms, and that is worth every ounce of effort. Achieving financial independence is a powerful and rewarding goal. It gives you the ability to control your life, pursue your passions, and build a legacy for future generations. Start now, stay disciplined, and the future you've always dreamed of is within reach. As you progress on your path to financial freedom, it's essential to remember that financial independence isn't just about accumulating wealth. It's about creating a life that aligns with your values and allows you to live with purpose and fulfillment. Money, after all, is just a tool. The real goal is to use that tool to design a life that brings you joy, freedom, and meaning. In this section, we will dive deeper into the concept of financial well-being, a holistic approach to money management that considers not only your finances, but also your emotional and psychological relationship with money. This approach will help you achieve a balanced, stress-free financial life, rather than just focusing on accumulating wealth for its own sake. Step 1. Align your money with your values. One of the most powerful aspects of financial independence is the ability to make decisions based on your values, not on external pressures or societal expectations. Many people live their lives in pursuit of things they believe will bring them happiness: an expensive house, the latest gadgets, or designer clothes, without stopping to think about whether those things actually contribute to their happiness or life satisfaction. To create a life of financial well-being, Start by identifying your core values. What truly matters to you? Is it spending time with family, helping others, traveling the world, or perhaps living sustainably and reducing your environmental footprint? Money should be a means to support your values, not the other way around. Once you've identified your values, make sure your financial decisions align with them. For example, if spending time with family is one of your top values, ensure that you allocate time and money toward family vacations or creating experiences that foster connection. If giving back is important to you, consider donating a percentage of your income to charity or using some of your wealth to support causes that align with your beliefs. When your money is aligned with your values, you feel more fulfilled and in control. You're not just working to accumulate wealth for the sake of wealth. It becomes a tool to help you create the life you truly desire. Step 2. Focus on financial health, not just wealth. As you move forward in your financial journey, it's easy to get caught up in the numbers. But wealth isn't just about having a large bank balance. It's about having financial health and peace of mind. Financial health encompasses more than just having enough money to cover your bills. It includes a sense of financial security and emotional well-being. Think about it. How often do you worry about money? For many people, money is a constant source of stress, whether it's anxiety about debt, the pressure to keep up with peers, or fear of an uncertain future. Financial health means breaking free from those worries and achieving peace of mind about your financial situation. To cultivate financial health, here are a few practices to consider. Live within your means. This doesn't mean living a life of deprivation, but it does mean being mindful of your spending and recognizing when lifestyle inflation is creeping in. Be conscious about balancing your wants and needs. Focus on what you can control. While the economy and the markets may be beyond your control, you have complete control over your spending habits, savings, and investment strategies. Focus on doing the best you can with the resources available to you. Build emotional resilience. Money isn't just about the numbers. It's about how you feel about your finances. Practice mindfulness and emotional resilience to reduce stress and stay calm during financial challenges. Remember, financial setbacks are temporary, but your mindset can have a lasting impact on your journey. Prioritize self-care. It's easy to fall into the trap of constantly working to earn more money, but your health and well-being are just as important. Take time to exercise, eat well, and take care of your mental health, as these elements directly contribute to your ability to make good financial decisions. Step 3. Practice mindful spending. One of the cornerstones of financial well-being is mindful spending. It's easy to get caught up in impulsive purchases or societal pressure to buy things you don't need. But mindful spending involves being intentional with every dollar you spend, making sure it aligns with your values and goals. Here's how you can practice mindful spending. Track your emotional spending. Many purchases are made based on emotions, stress, boredom, or trying to keep up with others. Track your spending to identify patterns. Are there certain times when you tend to spend more, like when you're feeling down or trying to cheer yourself up? Being aware of these emotional triggers can help you take a step back and reassess before making unnecessary purchases. Think before you buy. Before making a purchase, ask yourself a few key questions. Does this item contribute to my long-term happiness? Will this purchase help me achieve my financial goals? Do I truly need it? Or is it something I want in the moment? By considering your purchase carefully, you prevent impulsive spending and make sure your money is going toward things that truly matter to you. Create a spending plan for discretionary expenses. It's important to give yourself permission to enjoy life. Life isn't all about deprivation. It's about finding a balance. You can still enjoy things like dining out, entertainment, or hobbies, but do so in a way that's intentional. Allocate a specific amount of your monthly budget for discretionary expenses and stick to it. This way, you can indulge in what you love without derailing your financial goals. Step 4. Create a giving plan. Another way to achieve financial well-being is by incorporating generosity into your financial plan. Giving back doesn't only benefit others, it also brings a sense of fulfillment and purpose to your own life. When you feel like you're contributing to something greater than yourself, money becomes a tool for positive change. Start by creating a giving plan that aligns with your values. How much would you like to donate or contribute to charity each year? Are there causes that are especially important to you? Whether it's donating a portion of your income or volunteering your time, incorporating giving into your financial plan brings a sense of balance and purpose. Step 5. Transitioning from accumulation to enjoyment. As you near financial independence, you may reach a point where you've accumulated enough wealth to live comfortably for the rest of your life. But it's essential to transition from a mindset of accumulation to one of enjoyment. This shift involves focusing less on growing your wealth and more on living the life you've worked so hard to create. Consider how you will spend your time once you no longer have to work. Is it about spending more time with family, traveling, starting a new project or hobby? The key is to embrace the lifestyle you've created and focus on enjoying it fully. Transitioning into a life of enjoyment is about being present and appreciating the wealth you've built, not just in terms of money, but in terms of time, experiences, and relationships. True wealth is the freedom to live life on your own terms. Financial well-being isn't just about accumulating wealth. It's about creating a life that reflects your values, goals, and passions. By aligning your money with what truly matters to you, practicing mindful spending, and building a life of balance, you can achieve a sense of financial peace that extends far beyond dollars and cents. Remember, the ultimate goal is not just to have money, it's to use it as a tool to live the life you've always dreamed of. You've been on quite the journey so far, mastering the fundamental aspects of money management, learning how to build wealth, and even thinking about long-term strategies for financial independence. But now, there's one more critical aspect to address that often gets overlooked in traditional financial discussions: financial mindset. Your mindset, the way you think about money, wealth, and your financial future, plays a huge role in whether you succeed or struggle in your financial journey. Your thoughts, beliefs, and attitudes about money shape your behavior, your decisions, and your long-term outcomes. Whether you realize it or not, you're already operating from a set of financial beliefs. The question is, are they helping or hindering you? In this section, we'll explore how to cultivate a mindset that empowers you to make better financial decisions, push through challenges, and ultimately, create the life you envision. Your mindset will be the key to unlocking the next level of your financial freedom. Step 1. Understand the psychology of money. First, it's essential to understand that money is not just about numbers. It's deeply psychological. The way you view money influences your financial choices in ways that go beyond logic. How you were raised, your cultural beliefs, past financial experiences, and even your personality traits can all shape your financial mindset. For example, if you were taught that money is scarce, you might find it difficult to spend money on things that matter, or to even enjoy what you already have. If you grew up in an environment where money was a constant source of stress, you might be prone to either hoarding money or avoiding it altogether because of the anxiety it causes. The first step to changing your financial future is to recognize your current mindset. Ask yourself questions like, do I view money as a source of stress or empowerment? Do I feel worthy of financial success? How do I handle financial setbacks? Do I avoid them? Or do I learn from them? Once you understand where your mindset currently stands, you can begin to make shifts toward a healthier, more abundant perspective. Financial success starts with adopting an empowering mindset that encourages growth, opportunity, and self-belief. Step 2. Cultivate a growth mindset. A growth mindset is the belief that your abilities and intelligence can be developed over time through hard work, learning, and persistence. This mindset is especially important in the realm of personal finance, where success doesn't happen overnight. When you embrace a growth mindset, you stop seeing failures as permanent or discouraging. Instead, you view them as learning opportunities. If you make a financial mistake, like overspending or making an investment that doesn't pay off, you learn from it and adjust. You don't let a setback define your future. To cultivate a growth mindset in your finances, adopt these habits. Embrace challenges instead of shying away from complex financial topics. Dive into them. Learn about investing, taxes, retirement planning, and other areas that seem intimidating at first. The more you learn, the more your financial confidence will grow. Focus on effort, not results. While it's important to have goals, don't be discouraged by slow progress. Understand that consistent effort over time will compound into success, even if the results aren't immediately visible. Learn from setbacks. Mistakes will happen. The key is not to beat yourself up, but to use them as stepping stones to improve your strategy. Every misstep is a lesson that brings you closer to financial success. Step 3. Overcome the fear of money. Fear is one of the most common emotional blocks when it comes to money. Fear of making the wrong financial decisions, fear of running out of money, or even fear of success can all prevent you from taking necessary actions to improve your financial situation. The first step in overcoming this fear is acknowledging it. If you feel anxious about budgeting, investing, or setting financial goals, that's normal. But fear shouldn't paralyze you. Instead of avoiding financial decisions, use strategies that help you take action despite your fear. Here's how to start overcoming the fear of money. Start small. If investing feels daunting, start with small contributions to a retirement account or low-cost index funds. As you see your money grow, you'll become more comfortable with the process. Educate yourself. Knowledge is power. The more you understand how money works, the less intimidating it will seem. Read books, listen to podcasts, or talk to a financial advisor. Empowering yourself with knowledge will reduce fear and increase your confidence. Take calculated risks. Understand that every financial decision carries some risk, whether it's investing in the stock market or buying real estate. Risks are part of the process, but the key is to take calculated risks, where you've done your research and have a solid plan in place. Over time, You'll build confidence in your ability to make sound financial decisions. Step 4. Embrace abundance over scarcity. Many people operate from a scarcity mindset, believing that there's never enough money to go around. This belief leads to stress, anxiety, and sometimes hoarding behaviors. On the other hand, an abundance mindset is based on the belief that there's plenty of money and opportunities for everyone. When you embrace an abundance mindset, you stop viewing money as a finite resource and start seeing it as something that can be created, managed, and grown. You start to believe that you are fully capable of achieving financial freedom, and that wealth is available to anyone who is willing to work for it. To embrace abundance, try these strategies. Practice gratitude. Focus on what you have, rather than what you lack. Keeping a gratitude journal can help shift your focus toward abundance and positivity, rather than scarcity and lack. Think long-term. Stop focusing on short-term wins, and instead, think about how you can grow your wealth over the long term. Investing, saving, and creating passive income will enable you to build wealth steadily. Visualize abundance. Spend time imagining the life you want to live. Visualize yourself achieving your financial goals, living comfortably, and contributing to the world around you. This creates positive energy around money and reinforces the belief that you can attract abundance into your life. Step 5. Build confidence in your financial decisions. Confidence plays a crucial role in financial success. If you lack confidence in your ability to manage money or make sound financial decisions, you might hesitate to take necessary steps or even avoid dealing with your finances altogether. Building financial confidence comes from taking action, learning from mistakes, and celebrating progress. Here's how you can boost your financial confidence. Start with what you know. If you're not comfortable with investments yet, begin by mastering budgeting and saving. As you become more familiar with the basics, you'll gain the confidence to move into more complex areas, like investing. Track your progress. Regularly review your financial goals and celebrate the small wins. Did you pay off a credit card? Did you stick to your budget for the month? Recognizing these milestones boosts your confidence and helps you stay motivated. Surround yourself with positivity. Join communities or find mentors who support your financial journey. When you're surrounded by people who believe in financial freedom, you'll be inspired to keep going, even when times get tough. Step 6. Develop the habit of financial self-reflection. Finally, one of the most powerful ways to maintain a healthy financial mindset is to reflect regularly on your financial journey. Reflection helps you stay aligned with your goals, adjust when necessary, and celebrate your successes. To make financial self-reflection a habit, try these practices. Monthly financial check-ins. Take a few minutes each month to assess your progress. Are you on track to meet your savings or investment goals? What financial challenges did you face? And what can you do differently next month? Review your mindset. Reflect on your relationship with money. Are there any limiting beliefs you need to address? Are you staying focused on abundance and growth? Regular self-reflection helps you stay grounded in the right mindset. Financial success is not just about the numbers. It's about your mindset and how you approach challenges, opportunities, and growth. By developing a growth mindset, overcoming fear, and embracing abundance, you'll cultivate the mental resilience necessary to achieve financial freedom. Your financial journey is just as much about who you become along the way as it is about what you achieve. With the right mindset, you'll continue to make sound financial decisions, stay disciplined in your goals, and ultimately create a life of true freedom and fulfillment. As you work toward financial independence, you may reach a point where you've built a strong foundation, a budget you stick to, savings that are growing steadily, and investments that are beginning to compound. But even with all this progress, you still face a critical question. How do you maintain momentum and avoid financial burnout? It's easy to get caught up in the process of financial planning, especially when you start seeing your progress. The excitement of hitting financial milestones, paying off debt, increasing savings, seeing investments grow can be exhilarating. But over time, maintaining your focus and avoiding burnout becomes essential if you want to keep building on your success. This section focuses on how to stay engaged with your financial journey over the long term, maintaining balance, avoiding stress, and ensuring that your financial success is sustainable. After all, building wealth isn't just about reaching your goals, it's about living a fulfilling life while you do it. Step 1. Celebrate your wins. Big and small. One of the most effective ways to stay motivated and avoid burnout is to celebrate your wins along the way. Whether it's a small victory, like sticking to your budget for the month, or a larger one, like hitting a savings target or paying off a big chunk of debt. Celebrating milestones is a powerful motivator. Celebrating doesn't mean spending money or going on an expensive shopping spree, unless that's truly in line with your goals. Instead, think about celebrating in ways that bring joy and fulfillment without derailing your financial plan. Here are some ideas for celebrating your progress. Take a day off. Give yourself a break to recharge and reflect on your accomplishments. Enjoy a small indulgence. Treat yourself to something you enjoy, whether it's a favorite meal, a relaxing activity, or something else that feels rewarding. Share your success. Talk to friends or family about your progress. Sharing your wins can help keep you motivated and encourage others to pursue their own financial goals. Recognizing the effort you've put in to reach each milestone, no matter how small, keeps the momentum going. This helps you see that your journey is about more than just numbers. It's about growth, discipline, and consistent effort over time. Step 2. Make financial progress enjoyable. If your financial journey starts to feel like a chore, you risk burnout. Financial success is about more than reaching a goal. It's about creating a sustainable, enjoyable process that you can stick to for the long haul. The first step to making financial progress enjoyable is to find ways to make the process fun. Here are some ways to inject enjoyment into your financial journey. Gamify your goals. Turn your financial goals into challenges. Whether you're tracking your spending, paying off debt, or reaching a savings target, make it a fun competition. You can reward yourself when you hit your goals and enjoy the satisfaction of winning the game. Involve your family or friends. If you're on a journey to improve your finances, involve your loved ones. Set shared financial goals, like saving for a vacation or contributing to a family emergency fund, and celebrate the progress together. Set personal rewards. As you hit financial milestones, reward yourself with activities that bring you joy. Instead of buying material things, consider rewarding yourself with experiences, like a weekend getaway or a fun outing. These rewards contribute to your well-being and keep your focus on the bigger picture. Financial planning doesn't have to be a daunting task. With the right mindset, you can create a process that feels enjoyable and satisfying, ensuring you stay engaged with your financial goals without burning out. Step 3. Create a flexible financial plan. Financial success is not about being rigid and inflexible. It's about creating a plan that works for you while still allowing you the freedom to adjust as life changes. Whether it's an unexpected expense, a shift in income, or new financial goals, life happens. That's why your financial plan needs to be adaptable. A flexible plan allows you to pivot when circumstances change without feeling like you've failed or veered off course. Here's how to create a plan that is both effective and adaptable. Budget with flexibility. While it's important to have a clear budget, ensure that there's room for unexpected expenses. Set aside some discretionary spending or allocate extra funds to savings when you have the flexibility to do so. This cushion helps you avoid panic when things don't go as planned. Track progress, not perfection. Don't get discouraged by setbacks or mistakes. Remember, it's not about being perfect. It's about making consistent, positive progress. Review your goals periodically and adjust your plan based on where you are and where you want to go. Set quarterly financial reviews. Every 3 months, take a step back and assess how well your financial plan is working. Have your priorities shifted? Has your income increased or decreased? Use these reviews to make tweaks and ensure you're staying on track to meet your larger goals. Being adaptable doesn't mean giving up on your goals. It means staying open to new possibilities and adjusting your course when needed. Life will always have unexpected challenges, but with a flexible plan, you'll be able to face them with confidence and continue making progress. Step 4. Avoid the comparison trap. In the age of social media, it's easy to fall into the trap of comparing your financial journey with others. It's natural to look at people who seem to be achieving their goals faster or living the lifestyle you aspire to. However, comparison is a recipe for dissatisfaction and can lead to frustration or even burnout. Instead of focusing on others' financial successes, keep your focus on your own journey. Your path to financial freedom is unique to you, and it's not about how fast you're progressing compared to others. It's about staying consistent, focused, and aligned with your goals. Here's how to avoid the comparison trap. Celebrate your own progress. Rather than comparing yourself to others, focus on your own growth. Look back at where you were a year ago and celebrate how far you've come. Every step forward is progress, and that's what matters. Focus on your own values. Your financial goals are deeply personal. Don't let someone else's lifestyle or financial situation distract you from what's truly important to you. Define your own version of success and work toward that, not someone else's. Limit exposure to social media. Social media can often lead to unhealthy comparisons. While it's fine to follow people who inspire you, be mindful of how much time you spend scrolling through posts that make you feel inadequate. Instead, spend time focusing on the actions that will improve your own situation. Your financial journey is yours and yours alone. By resisting the urge to compare yourself to others, you free up energy and focus that can be better used toward building the life you truly want. Step 5. Learn how to manage stress effectively. Stress is an inevitable part of life, and it can be especially prominent when dealing with finances, whether it's dealing with debt, saving for a big purchase, or navigating an economic downturn. Financial stress can feel overwhelming, but it's important to manage stress effectively so it doesn't undermine your efforts. Here are some stress management strategies that can help you maintain balance during tough times. Practice mindfulness and meditation. Take time each day to practice mindfulness. Focus on the present moment, breathe deeply, and clear your mind. Meditation can help you stay calm and reduce anxiety when things feel uncertain. Exercise regularly. Physical activity is one of the best ways to manage stress. Whether it's going for a walk, hitting the gym, or practicing yoga, regular exercise can help you release tension and improve your mental clarity. Seek support. If financial stress is overwhelming, talk to a trusted friend, family member, or financial advisor. Sharing your worries can help you gain perspective and reduce the weight of financial challenges. Financial success doesn't just rely on numbers. It also depends on your ability to manage the stress that comes with building wealth. By practicing stress management techniques, you can stay focused on your goals without letting stress derail your progress. Step 6. Stay connected to your why. One of the most powerful tools you have to keep your financial momentum going is a deep connection to your why, your reason for working toward financial freedom in the first place. Your why is your motivation to keep going, especially when the path gets tough. It's the thing that will help you push through setbacks and stay disciplined when it feels like you're not making fast enough progress. To keep your motivation high, reflect on your why regularly. Whether it's the freedom to travel, spend more time with family, or create a legacy for your children. Reconnecting with the reason behind your financial journey will fuel your drive. Write it down, share it with loved ones, and keep it in the forefront of your mind as you move forward. Building wealth and achieving financial freedom is a long-term journey, but it's a journey that doesn't have to be overwhelming. By celebrating your wins, making financial progress enjoyable, and maintaining balance, you can stay engaged and avoid burnout. Keep your eyes on the prize and trust the process. It's all about consistent action, mindset, and enjoying the ride. As you continue forward, remember that financial freedom is not an end destination. It's a dynamic, ever-evolving journey. Stay disciplined, be adaptable, and always keep your long-term vision in mind. Your financial success is in your hands. As you continue progressing toward financial independence, it's important to remember that the journey doesn't stop once you reach your goals. Financial success is an ongoing process that involves regularly revisiting your financial situation, adjusting your goals, and finding ways to optimize your wealth-building strategies. At this stage in your financial journey, you've made great strides toward achieving long-term wealth. However, sustaining and growing that wealth requires constant attention, adaptation, and strategic planning. In this section, we will explore how to optimize your financial plan, stay on track, and continue to build wealth for the future. It's easy to get complacent once you've established a solid foundation, but true financial success is about constantly improving, finding new opportunities, and staying proactive in your financial decisions. Let's dive into how you can ensure that you're not just maintaining your financial progress, but continually growing it. Step 1. Regularly reassess your financial goals. As your life evolves, so should your financial goals. It's important to regularly reassess your financial objectives and make sure they still align with your changing needs, desires, and circumstances. While it's tempting to set and forget your goals, reviewing them at least once a year is essential to staying on track. Ask yourself, have your priorities changed? Maybe you've achieved some of your initial goals, and now you're looking to set new ones, like starting a business, buying a second home, or increasing your charitable giving. Is your financial plan still relevant? As your income grows, or your expenses change. Your budget and investment strategies may need adjusting. Are you on track to meet your retirement goals? If your retirement date has changed, or if your desired lifestyle in retirement is evolving, it's important to revise your projections. Reassessing your financial goals gives you the opportunity to refocus your efforts and make any necessary adjustments. This helps ensure that your financial plan reflects your current life stage and future aspirations, rather than being stagnant or outdated. Step 2. Optimize your investment portfolio. Once you've gained a solid understanding of investing and built your wealth, it's time to shift your focus to optimizing your investment portfolio. As you approach financial independence, you need to ensure that your investments continue to work hard for you and align with your long-term goals. Consider the following strategies for portfolio optimization. Review asset allocation. Your asset allocation should reflect your goals and risk tolerance. As you approach financial independence and retirement, you may want to shift toward more conservative investments to protect your capital while still enjoying growth potential. This might involve moving a portion of your portfolio into bonds, dividend-paying stocks, or cash equivalents. Diversify further. While you may have already diversified your investments between stocks, bonds, and real estate, there are other ways to further diversify. Consider adding international stocks, sector-specific investments, or alternative assets like commodities or peer-to-peer lending platforms. Diversification reduces risk by spreading investments across different types of assets, markets, and economies. Tax optimization. Review your investment accounts to ensure you're utilizing tax-efficient strategies. For example, holding stocks for the long term in a tax-advantaged account, like an IRA or Roth IRA, allows you to avoid paying taxes on dividends and capital gains. Similarly, tax loss harvesting can help offset gains with losses, minimizing your overall tax burden. Rebalance your portfolio. Rebalancing involves selling investments that have grown disproportionately and using the proceeds to buy more of underperforming assets. This ensures that your portfolio stays aligned with your risk tolerance and goals. It's especially important to rebalance when there's a market correction or a major change in your financial goals. By periodically optimizing your portfolio, you ensure that it's working to support your financial independence and future wealth. A well-optimized portfolio also allows you to sleep easy at night, knowing your investments are structured to weather any financial storms. Step 3. Continue to build multiple income streams. While traditional income sources like a paycheck or salary are vital, financial independence thrives on diversified income streams. Continuing to build additional income sources will increase your financial resilience and speed up your wealth-building journey. Here are some ways to continue building multiple income streams. Side hustles and freelance work. If you have a skill or passion, consider turning it into a side hustle. Freelance writing, graphic design, web development, consulting, and tutoring are just a few of the countless opportunities available. A side hustle can provide both supplemental income and personal fulfillment. Invest in passive income sources. Passive income comes from sources like rental property, dividends from stocks, interest from bonds, and royalties from intellectual property, books, music, patents, etc. Consider growing your investments in these areas so you can eventually rely on these passive income streams to support your lifestyle. Start a business. If you're interested in entrepreneurship, now might be the time to start a business that aligns with your passions. While starting a business comes with risks, it can also provide you with significant income, growth, and the potential for future sale or expansion. Automate your income. As you progress in your career or entrepreneurial ventures, focus on automating aspects of your income generation. For example, you could set up automated online sales, subscription-based business models, or rental property management systems to create steady streams of income with minimal effort on your part. Building diverse income streams provides security and increases your ability to accelerate savings, pay down debt faster, or reinvest in other areas of your financial plan. The more sources of income you have, the more financial freedom you'll experience. Step 4. Focus on long-term wealth preservation. While accumulating wealth is important, preserving your wealth is equally essential. As your wealth grows, you'll want to protect it from inflation, market volatility, and potential losses. To do this, you need to incorporate strategies that help safeguard and preserve your wealth for the long term. Some key strategies for wealth preservation include inflation protection. Inflation erodes purchasing power over time, which means your money doesn't stretch as far in the future. Consider investing in assets like real estate or TIPS, Treasury inflation-protected securities, which are designed to outpace inflation and maintain purchasing power. Estate planning. As your wealth grows, it's important to ensure that it's distributed according to your wishes. Estate planning tools like wills, trusts, and powers of attorney can ensure your wealth is protected and passed on efficiently to your loved ones or charitable organizations. Long-term care and insurance. As you age, the risk of needing long-term care increases. Health insurance and long-term care insurance can protect your assets from being depleted by medical expenses or nursing home care. Additionally, umbrella insurance policies can offer additional protection for your assets in the event of unexpected lawsuits or claims. Diversify risk. Protect your wealth by diversifying the risks you face. Don't put all of your money into a single asset or investment strategy. A combination of stocks, bonds, real estate, and insurance can mitigate the financial impact of unexpected events. By focusing on wealth preservation, you're ensuring that your hard-earned assets are safeguarded against risks that could derail your financial future. This allows you to enjoy your wealth with confidence, knowing that it's protected and prepared for future generations. Step 5. Embrace the lifestyle of financial independence. At this stage, achieving financial independence is within your reach. The key now is to embrace the lifestyle of financial freedom. It's not just about reaching a number or having a large bank balance. It's about living intentionally and making decisions that reflect your personal values, goals, and desires. Living the lifestyle of financial independence means pursuing passions. You no longer have to work solely for a paycheck. Financial independence gives you the freedom to explore your passions, whether that's traveling, starting a business, or contributing to causes you care about. Spending consciously. With financial freedom comes the opportunity to spend money more consciously and in ways that align with your values, whether it's supporting charitable causes, investing in experiences, or supporting your loved ones. Living consciously with your wealth brings more fulfillment than simply accumulating material possessions. Creating a legacy. As you continue to build wealth, think about how you can create a legacy, whether that's through a charitable foundation, passing down wealth to your family, or making a difference in your community. Financial independence enables you to not only live the life you've dreamed of, but to also leave a positive impact on future generations. Achieving financial independence isn't just about financial security. It's about using that security to design a life filled with purpose, joy, and freedom. The lifestyle of financial independence is a life where you are the one in control of your time, money, and future. Reaching financial independence is not a destination, but rather a journey that requires continuous reflection, adaptation, and improvement. By optimizing your investment strategy, building multiple income streams, preserving your wealth, and embracing the lifestyle of financial freedom, you ensure that your financial success is sustainable and fulfilling for years to come. Keep moving forward, stay flexible, and enjoy the process of building a life that aligns with your vision of financial independence and freedom. As you near the final stages of your financial journey, it's important to pause and reflect on how far you've come and what lies ahead. Achieving financial freedom and independence is not an easy task, but the journey itself is just as rewarding as the destination. The habits, knowledge, and discipline you've developed along the way will continue to benefit you for years to come. In this final section, we will focus on the mindset and strategies that will help you maintain your momentum, stay on track with your long-term goals, and continue growing your wealth sustainably. Reaching financial independence is a significant accomplishment, but it's also the beginning of a new chapter, a chapter where your money works for you, and you have the freedom to live life on your own terms. Step 1. Shift from an accumulation mindset to a sustainability mindset. Up until now, the focus has likely been on building wealth, saving, investing, and accumulating enough assets to become financially independent. However, once you reach a point of financial freedom, the focus shifts from accumulating wealth to sustaining and growing that wealth over time. A sustainability mindset is about preserving capital. You've worked hard to build your wealth, so it's important to protect it. This doesn't mean being overly conservative with your investments, but it does mean being mindful of risk, managing it properly, and ensuring that your assets are generating reliable returns over the long term. Reinvesting profits. As you accumulate wealth, it's easy to focus on enjoying the fruits of your labor, but the key to sustaining and growing your wealth is to keep reinvesting your profits. Whether it's increasing your retirement contributions, buying more real estate, or diversifying into new investment opportunities, reinvesting your returns accelerates your wealth-building process. Minimizing unnecessary spending, even though you might have the freedom to spend more now. Maintaining a sustainable lifestyle is about balancing enjoyment with discipline. Resist the temptation to live beyond your means just because you can. Instead, focus on making mindful decisions that keep you on track for long-term success. The shift from accumulation to sustainability involves thinking long-term and making decisions that ensure your wealth lasts for the rest of your life and possibly beyond. Sustaining wealth is about creating a system that will continue working for you, even when you're no longer actively managing it. Step 2. Embrace the power of giving back. One of the most fulfilling aspects of financial freedom is the ability to give back, whether it's through charitable donations, helping others in your community, or creating a legacy for future generations. As your wealth grows, the opportunity to make a positive impact also increases. Giving back has several benefits. It enriches your life. There's nothing more rewarding than knowing your resources are helping others. Whether you're funding a charitable cause, supporting educational initiatives, or contributing to environmental sustainability. Giving back creates a sense of fulfillment and purpose. It strengthens your legacy. By focusing on giving, you begin to build a legacy that extends beyond just the financial wealth you accumulate. Your legacy is about the positive impact you leave on others, the causes you support, and the values you uphold. It encourages a mindset of abundance. Generosity is a powerful reminder that wealth is not just meant to be hoarded. The more you give, the more you realize that there's always enough to share. It fosters a sense of connection and purpose, which is crucial in maintaining a balanced, rewarding life. Start by determining which causes are most meaningful to you. Whether it's donating a percentage of your income or starting your own foundation. The act of giving can become a fulfilling and essential part of your financial journey. Giving not only makes a difference in the lives of others, but also adds a sense of purpose and satisfaction to your own life. Step 3. Continue building financial literacy. Even after achieving financial independence, it's essential to keep learning and growing in the realm of personal finance. Financial literacy doesn't have an expiration date, and the more you know, the better equipped you'll be to make informed decisions about your money. To continue building financial literacy, read books and articles. There are countless resources available to help you deepen your understanding of various financial topics, from investing and estate planning to tax strategies and retirement planning. Keeping up with the latest financial trends will ensure you make informed decisions about your money. Follow financial thought leaders. Many successful individuals and financial experts regularly share valuable insights and advice. Follow blogs, podcasts, and social media accounts dedicated to personal finance. This continuous learning will keep you updated on new strategies, tools, and opportunities. Consult with professionals. Even if you've reached financial independence, working with financial advisors, tax experts, or estate planners is a wise move. These professionals can help ensure that your wealth is optimized for both growth and protection, offering advice tailored to your unique situation. The more you learn, the more you can fine-tune your wealth-building strategies, ensuring that your financial independence lasts and grows for the long term. Step 4. Stay disciplined and focused on your long-term vision. Discipline is one of the cornerstones of financial success, and even once you've achieved financial independence, it's essential to stay disciplined and focused on your long-term vision. The allure of spending money freely can be tempting, but staying true to your values and goals will allow you to enjoy your wealth while ensuring it lasts. Some tips for maintaining focus. Keep track of your financial goals. Regularly check in on your financial objectives, even if you've reached a level of independence. Setting long-term goals, whether it's maintaining a certain level of passive income, growing your investments, or leaving a legacy, helps you stay connected to your purpose. Avoid complacency. Financial independence shouldn't mean complacency. While it's important to enjoy your financial freedom, it's equally important to continue working toward growth, whether that's increasing your wealth, giving back, or further developing your skills and knowledge. Practice patience. Wealth building is an ongoing process, and it often takes time to see the full benefits of your efforts. Be patient with yourself and your financial plan. Let your investments compound, and let time work in your favor. Remaining disciplined allows you to ensure your financial independence isn't just a temporary achievement, but a sustainable lifestyle that will carry you for the long term. Step 5. Focus on health and well-being. One often overlooked aspect of financial independence is health. True financial freedom is not just about having money. It's about having the time, freedom, and energy to enjoy your life. Your health is the foundation of everything you want to accomplish, including your financial goals. Prioritize health and well-being by staying active. Regular exercise is not only good for your body, but it also enhances mental clarity, reduces stress, and boosts overall productivity. Eating well. A balanced diet is essential for long-term health. Fueling your body with the right nutrients will give you the energy you need to stay focused on your goals and enjoy life. Taking breaks. Financial independence allows you to take time off and prioritize self-care. Make sure to take regular breaks to recharge, whether through vacations, hobbies, or simply spending time with loved ones. Remember, wealth without health is incomplete. Protecting your well-being will help you continue living the lifestyle of financial freedom with energy, joy, and longevity. As you complete your journey toward financial independence, take time to appreciate the path you've taken. Remember, the process of managing your wealth is a dynamic, evolving experience that requires consistency, adaptability, and long-term vision. Stay disciplined, continue learning, and always focus on the bigger picture, using your wealth to live the life you've dreamed of. True financial independence is not just about accumulating wealth. It's about creating a life filled with freedom, purpose, and fulfillment. Embrace this new chapter of your life with confidence and excitement, knowing that you've built a solid financial foundation that will carry you for the rest of your days.